Everyone knows Florida as a low-tax destination, no state income tax, and real estate that attracts buyers from all over the country. But if you look at a property listing and budget your monthly payments based on the current owner's property tax bill, you are walking straight into a trap. Come year one, you will get hit with a massive, unexpected payment shock. This chart plots the trap. The bottom shows years owned, the side shows the gap between market and assessed value. Long-term owners on the right enjoy massive discounts. On the left, new buyers' taxes instantly reset to peak market value. The reason so many buyers get caught off guard is that they confuse two completely different Florida laws. They think the Homestead Exemption and Save Our Homes are the exact same thing. They aren't. We are going to separate those two laws right now. We'll look at the exact math you need to run depending on the specific type of move you are making. Navigating this system comes down to identifying which bucket you fall into: a first-time Florida buyer, an upsizing homeowner, or a downsizing homeowner, because the rules change dramatically for each. The first layer of protection is the Homestead Exemption. This is a straightforward discount that reduces the taxable value of your property by up to roughly $50,000. To qualify, the property must be your permanent primary residence as of January 1st of the tax year. But here is the catch. That exemption does not pass to the new owner. If the seller had the exemption, it dies at closing. You start from scratch. You have to proactively file an application with your county property appraiser. The exact paperwork you need is Form DR-501, and you must submit it by March 1st. Getting $50,000 knocked off your taxable value is helpful, but it is just your entry ticket into the system. It isn't what creates long-term tax savings in Florida. The real financial engine of Florida real estate is the Save Our Homes benefit. Once you have your homestead exemption established, the Save Our Homes law legally caps how much your assessed value can increase. It can never go up by more than 3% per year, or the Consumer Price Index, whichever is lower. This line graph shows a 10-year period. While market value shoots up and down, your assessed value stays on a smooth, capped incline. Over time, that creates a massive gap between market worth and taxable value. That gap is your Save Our Homes benefit. There is a catch, known as the recapture rule. Even if your home's market value stays perfectly flat, your assessed value will still creep up by 3% until it catches the market value. And when you sell the property, that accumulated cap is destroyed. The year after the sale, the assessed value snaps all the way up to match the full current market price for the new owner. This sudden reset is exactly why new buyers suddenly get hit with a massive surge in their monthly mortgage escrow payments. If you calculate your budget using the seller's artificially capped tax history instead of the reset market value, you will find yourself hundreds of dollars short every month. If you already own a homestead in Florida and you want to move, you can use a legal mechanism called Portability to take that accumulated tax shield with you. You have exactly 3 tax years from abandoning your portability, depending on whether you are upsizing or downsizing. If you are upsizing, buying a home with an equal or higher market value, you get 100% portability. You can transfer your accumulated tax gap to the new property up to a hard cap of $500,000. But if you are downsizing to a cheaper home, the math completely changes. You cannot take your full dollar amount in savings. You are only allowed to transfer a specific percentage of your shield. The state uses a strict formula to find that percentage. Take the value of your new home and divide it by the value of your old home. So if you sell a home with a $300,000 market value to buy a new one valued at $180,000, you divide $180,000 by $300,000. That means exactly 60% of your Save Our Homes benefit transfers. You are permanently surrendering a fraction of the tax shield you earned. You have to calculate exactly how much you are losing just to get that cheaper sticker price. Florida's property tax benefits are immense, but they are not automatic. They require precise execution. Let's map out exactly what you need to do based on your specific situation. This is your March 1 action plan. For first-time buyers and transplants from out of state, your strategy is strictly defensive. Budget your monthly payments for a full tax reset at current market value. Factor in that basic $50,000 exemption and file Form DR-501. If you are an upsizer moving from an existing Florida homestead, your plan is wealth preservation. Secure your full 100% transfer by filing the standard form DR-501 along with the special portability form DR-501T. And if you are downsizing, your plan is all about mathematical risk assessment. Calculate your fractional loss formula before locking in your purchase budget, then file both the DR-501 and DR-501T forms. The counting appraiser must have your paperwork in hand by March 1st. If you miss that date, you forfeit the entire year of savings. Florida's property tax system heavily rewards buyers who understand the rules and map out their specific move in advance. It severely punishes those who wait until closing day to figure it out.